what the committee just did. The Senate Banking Committee voted 15-9 to advance the Digital Asset Market Clarity Act, with all Republicans and at least 2 Democrats backing the bill, according to a detailed committee recap from CoinMarketCap's community coverage of the 15-9 vote. This is a significant procedural step. Most U.S. bills die in committee, so clearing this stage signals the bill is now a serious contender for floor time in the full Senate. The Clarity Act had already passed the House in 2025, so Senate committee passage aligns both chambers around some form of a comprehensive crypto market structure bill. 2. What the Clarity Act would change. The Act's core move is to end years of turf war between the SEC and CFTC by dividing responsibilities. The CFTC would gain primary oversight of digital commodities like Bitcoin once they meet maturity criteria, while the SEC would oversee digital assets that function as securities or investment contracts, as described in a Bitcoin.com breakdown of the bill. Beyond that split, the bill creates federal rules for centralized exchanges, brokers, custodians, and DeFi protocols, plus consumer protection standards intended to avoid FTX-style collapses. It also tightens rules around stablecoin yields by allowing rewards linked to active use, payments, trading, staking, but restricting bank-like interest on idle balances. DeFi developers would gain clearer safe harbor protections so they are not automatically liable for illicit use of open source code, while still leaving room for anti-money laundering enforcement. What this means: if some version of this bill becomes law, large U.S. institutions could get a clearer compliance roadmap for spot crypto, tokenized assets, and stablecoins, which could support deeper, more durable participation. 3. Next steps and main risks. The bill now goes to the full Senate, where it must win 60 votes to overcome a filibuster, then be reconciled with a House version and signed by the president. With Republicans holding 53 seats, several Democratic votes are essential. Opposition remains strong. Banking groups warn the stablecoin provisions could siphon deposits from banks, and labor unions plus law enforcement groups argue the bill could increase risks to retirement savings and weaken illicit finance enforcement, as highlighted in a market reaction piece from Yahoo Finance. Timing is another risk. A crowded Senate calendar, summer recess, and looming elections all compress the window. Prediction markets quoted in coverage show decent, but not certain odds of the bill becoming law in 2026, meaning setbacks or heavy amendments are still very possible. Confidence. High because multiple mainstream and crypto-native reports agree on the vote count, scope of the bill, and remaining legislative hurdles. Conclusion. The committee's approval of the Clarity Act is the clearest signal yet that Washington is moving toward a durable, statute-based crypto regime rather than case-by-case enforcement. For crypto users and builders, the upside is regulatory predictability and potentially greater institutional participation. But the final shape of those rules will depend on the Senate floor fight, reconciliation with the House, and how aggressively opponents can water down or stall the bill. This content is for educational purposes only and should not be considered financial advice. Subscribe to the channel and turn on notifications so you don't miss future updates.